Welcome to today's video. If you've been paying attention to the stock market lately, you might have noticed some extreme volatility. Sharp gains followed by steep declines. In this video, we will dive deep into the reasons behind the recent stock market crash and what you should expect moving forward. From the ongoing Israel-Iran conflict and rising crude oil prices to foreign investor outflows and domestic economic challenges, we will cover all the key factors driving this market downturn. So, stay tuned until the end for a clear picture of what's happening and how you can navigate these uncertain times. The stock market has been experiencing extreme volatility. It opened positively, but quickly saw sharp declines during the trading session. The Bank Nifty Index, which tracks top banking stocks, dropped by 2%, while the Nifty Index fell by around 87%. At one point, Bank Nifty gained over 100 points in just a few minutes, only to lose all those gains shortly afterward. This dramatic rise and fall created confusion and concern for traders, signaling high uncertainty in the market. 5 key reasons for the stock market crash. Ongoing Israel-Iran conflict. The geopolitical tensions in the Middle East, particularly between Israel and Iran, have significantly impacted global markets. Some experts speculate that this conflict could escalate into a larger global confrontation, perhaps even World War III. While this seems unlikely at the moment, the uncertainty surrounding the war has made investors nervous. The Middle East is crucial for global oil production, and any conflict there threatens the stability of oil supplies, pushing crude oil prices higher. Rising crude oil prices. The rise in crude oil prices has a direct impact on businesses that rely on transportation. As oil prices increase, transportation costs for companies go up, which affects their profit margins. Many businesses depend on transporting goods, raw materials, or products, and higher costs squeeze their profitability. When a company's profits are expected to decline, its stock price often follows suit. The stock market tends to react to anticipated events, so the rising crude prices have driven investors to sell off stocks, fearing future losses. Outflow of foreign institutional investors, FIIs. Another significant factor contributing to the market's decline is the outflow of investments by foreign institutional investors. These investors, who had been heavily investing in the Indian stock market, have started pulling out large amounts of capital. For instance, on one day alone, FIIs sold over 15,200 crore worth of shares. This withdrawal of foreign capital adds further pressure to the market, signaling reduced confidence in the Indian economy from international investors. China's economic strategies. China has implemented fiscal stimulus policies aimed at attracting foreign investment. These measures include tax breaks and other incentives to lure foreign investors who might have otherwise invested in markets like India. This diversion of foreign capital from India to China is contributing to the fall in Indian stock prices, as liquidity flows out of India and into Chinese markets. Domestic economic challenges. India is facing its own set of economic challenges, including inflationary pressures, particularly in food and fuel prices, which impact consumer spending and overall economic growth. Concerns about rising fiscal deficits, increasing government borrowing, and a slowdown in the industrial sector are all weighing on investor sentiment. Although global factors play a large role, these domestic issues are exacerbating the situation, causing more aggressive selling by investors. Additional factors. Influencing the market. Market overvaluation. Before the decline, the Indian stock market had been reaching record highs, and many experts warned that the market was overvalued. The correction was expected but was triggered by external factors like the Israel-Iran conflict, rising oil prices, and FII outflows. The overvaluation made the market more vulnerable to these shocks, intensifying the decline. Panic selling. Panic selling also plays a role in market crashes. When investors, especially retail investors, see sharp declines, they often panic and sell their holdings, which creates a snowball effect. As more investors sell, the market falls further, amplifying the volatility. Navigating these uncertain times. The speaker advises investors to remain calm and avoid making rash decisions, like selling stocks immediately out of fear. Although the market is currently facing several challenges, there may still be positive developments in the future. Investors are encouraged to take a long-term view and not base their decisions solely on short-term market movements. The market could stabilize once geopolitical tensions ease and economic conditions improve. Conclusion. In conclusion, the stock market's decline is the result of several interrelated factors, including geopolitical conflicts, rising oil prices, foreign investment outflows, global economic uncertainty, and domestic challenges. These factors have combined to create heightened volatility and investor fear, leading to the sharp correction seen in the market. Thank you for watching. I hope this breakdown helped you understand the key reasons behind the recent stock market crash and what might happen next. Remember, market volatility is a normal part of investing, and it's important to stay informed and make thoughtful decisions. If you found this video helpful, don't forget to like, share, and subscribe for more insights on market trends and financial tips. Let me know in the comments if you have any questions or topics you'd like me to cover in future videos. Stay calm, stay patient, and I'll see you in the next one.